General market update. Okay, so since the last time you've seen a podcast or heard a podcast from us, I think we've had some deals closing in the KFC brand. We've had two deals closing in the Wingstop brand, one in Popeyes, and then for the rest of the year at Unbridled Capital, I think we're projecting closings in Taco Bell, Burger King, KFC, Pizza Hut, and Popeyes. It's been all told, probably what'll be, I would say, an average year for our company in terms of the volume of business that we're doing. But I'll tell you, I think we've taken market share, and I think the deals that we've done have been larger in size, which I think we're skewing higher than everybody else. My guess is that 2024 will be a down year for most people who are like us in this industry relative to even 2023 and maybe 2022 as well. It's been a pretty slow center part of the year from March to now with new activity. But that's what we have on our docket. There's still a lot of kind of uncertainty with interest rates and presidential elections and things. That all may shake out, may make 2025 a bit of a more active year. We'll see how that goes as we get moving. I just feel like after 3 or 4 years of kind of pent up demand of people wanting to buy and sell things, there are going to be sellers that come to the market in greater quantity of these QSR assets. It's just a matter of when. It's probably going to happen in 2025, but who knows? That's one kind of comment. The second comment that I'll make before we start is RFDC is coming up, Restaurant Finance and Development Conference. It's at Le Fontainebleau, I guess is how you say it, in Las Vegas in November. I'm doing a panel again for the third year in a row, and this one's called Accelerating Growth Strategies for Franchisee Acquisitions. So if you come out there, please attend. I think it's like an 11:30 to 12:20 time slot on Tuesday. And that's local Pacific time, local time. And hang around before and afterwards. I'd love to say howdy to you and chat, answer any questions, get to know you. And I certainly appreciate those of you who stop me and say thank you for these kind of things that we do. During this webinar, if you have any questions, raise your hand. We'll see them and we'll try to answer them along the way. The way we've kind of fashioned this is we've got 10 questions I'm going to ask of Chris, and he's going to respond. And then we'll send out a link to this webinar via email afterwards, A, and then B, it will be on our website at unbridledcapital.com. You can just go to the resources tab and you can find it after a couple of days. And then C, we will dub it to a podcast, which will be season 6, episode 7 of the Restaurant Boiler Room. So for those of you who are listening to this or will listen to this on the Restaurant Boiler Room, thank you and what's up. So with that, we'll kick on up and we'll say hi to Chris Lomuto of Northmarq. I've known Chris for several years. He's an old hat in the industry here with over 25 years of experience. So he's almost my age. And
although, as I said, though, I'm very immature.
Very, very immature. You act younger than your age. Some people say I act way older than my age. I don't know. One of the things I've liked about Chris over the years of knowing him is that he is very much a tell it like it is person, and he's very analytical and puts out a really good amount of very specific analytical content. Those of you who know Unbridled know that we are very analytical people, so I'm just naturally attracted to that type of approach. So I think he brings a no nonsense approach to this, and I hope you'll find this webinar on real estate really informative. Okay, so we'll jump right in. And so Chris, welcome, and glad to have you aboard, brother.
I'm very excited to be here. You and I have been talking for a while. We have. I'll try not to get into the mutual admiration aspect of this, but I think you and I share, that affinity for the data and stuff like that, and so I think we've clicked really well in that regard.
For sure, 100%, and I'm excited. So here we go. Question number 1. All right. So permit me to turn my head as I read some of these questions and squint a little bit, like I said. But number 1 is going to be, what do QSR franchisees need to know about the state of the QSR real estate industry, and specifically, about sale leaseback and value of real estate? So fire away, and excited to hear your answers.
All right. Well, by the way, if it starts getting boring, just let me know. And we'll try to make it a little more entertaining. But so here's my thoughts. What do they need to know about what do franchisees need to know about the state of QSR real estate? I'm going to give you the bad news first. No surprises here. really there's no escaping interest rates. The interest rate increases from 2022 and 2023 hit the real estate markets pretty hard. It was a pretty significant number of moves in a short amount of time. And as a result, the commercial real estate markets, not just triple net, not just QSR, but in general, the commercial real estate markets have been pretty sleepy. Last year around this time, Cushman Wakefield, like another brokerage firm, had put out some research saying multifamily transactions were down 72% year over year last year in October, which to me, I'm sure if we have some real veterans here, they could probably point to some other times in history. But to me, I can't remember a downturn that fast, that significant before. Maybe during the height of the pandemic.
72%. 72%.
That's what Globe Street had published from Cushman Wakefield last year. Cushman said, by their count, multifamily transactions were down 72% year over year. That's astounding. Globe Street, like getting more current, Globe Street last week published an article saying from someone in the industry that said, by their count, overall CRE, commercial real estate transaction volume was the lowest in July since the depth of the pandemic. So it's not been, the most fun time to be a real estate broker. We're not, or we're not minting a lot of new millionaires in our industry the last couple of years. But the good news is that realistically, QSR is still, in a lot of ways, king of the hill when it comes to desirable triple net real estate and desirable real estate in general. It's still extremely popular for real estate investors. It's very, very liquid in terms of like getting in and getting out of it. It's very easy to own. It tends to be very reliable real estate in terms of like vacancy and occupancy and stuff like that. There's not a lot of, relative to like any other type of real estate you can think of, there's not a lot of vacancy in triple net in general, and especially in QSR. And then QSR has weathered a lot of storms and has done so better than a lot of other product types. So like demographic changes in terms of people, moving from the suburbs to the cities and then back to the suburbs, moving from, the center of the country to the coast, all that stuff. The Amazon retail apocalypse, several recessions, a pandemic, work from home, inflation, those storms, had a pretty significant impact on various types of real estate. And through all that, QSR has mostly come out smelling like a rose. And I think not only does the real estate industry understand that at this point, even people that are really not that tuned into commercial real estate have seen that now. So what do franchisees need to know? Interest rates have affected all of us, but QSR real estate is still, in my book, king of the hill, and I think a lot of people would probably agree with it.
It's funny, your perspective is that, king of the hill and all of this stuff, and certainly it's been a fairly resilient industry. I always tell people who are looking to invest in this business, it's like you're not hitting home runs in this industry. You're hitting singles and you're legging it out and sliding into second base for a double type of thing. It's fairly cash flow stable and such, but we've had our own kind of bumps in the road on the operations side of the business across the country. I don't know the time frame, but I just saw a little article, and yesterday was saying that QSR, fine dining's down 6%, same store sales. I don't know the time frame. I think it was maybe that was fine and casual dining. Maybe it was QSR was like plus 1.5. Traffic in QSR down 2 or 3. This may not be representative of the whole country, may not be representative of of all the brands, but just to give you some perspective as you speak through this, and for those of you who are listening, we the traffic situation, heavy discounting, lower traffic, sales either flattish or modestly positive, but the industry is trying to bounce back itself. But let's go to question number 2. I think that was a great first stop. The next question is, given that the net leased QSR real estate is still desirable, what has the impact been from these higher interest rates? So I know everyone's kind of juggling with that. What do you say, Chris?
So from my point of view, there's been two main impacts, or at least that come to mind for me. So the first one is a pretty straightforward change in pricing, kind of based on what I call like basic financial economics. And I know we have like a range of people here today, some CFOs and some that are really strong financially and others that are probably more operationally focused. So just for like quick refresher on context, when I talk about like financial economics. So when banks, I'm talking about just everyday banks, can park money at the Federal Reserve and earn 5% with no risk, which is kind of what the federal funds rate is telling you, right? That risk reward relationship tends to filter through the entire financial system and raises expectations on every other type of investment as well, right? Once people start to see that you can earn a certain amount of reward per unit of risk over here, that market forces will adjust the yields over here to bring things back into equilibrium. And so that's kind of like a fancy way of saying a rising tide lifts all ships. So prices on investments that have relatively fixed cash flows, of which we can count, triple net real estate as one. Also mortgages and bonds and things like that. That those cash flows are pretty much fixed by a contract. In our case, we're talking about a lease. Investments like that tend to be especially sensitive to higher yields because when your cash flows are fixed, there's really no chance of like raising the income in the future to get more yield out of that investment, right? You can't, when you own a property with a lease, you can't just raise the rents, right? Those rents are fixed in the lease. So the only way to get more yield out of something with fixed cash flows, we can like get into all types of pedantics. If we have CFAs that are sitting here, I'm sure they would love to have a spirited debate. But practically speaking, for something with like fixed known cash flows, like a single tenant, real estate with a fixed lease, the only way, practically speaking, to get more yield out is to lower the acquisition price. So that impact is sort of, while it's unfortunate, it is healthy and rational and expected. And I think anyone who kind of understands basic finance would normally expect something like that. So that's sort of the first impact. The
So
second
in other
impact,
words, to say it to a simple man like myself, if I could get 5% by dropping the money into a money market fund, why would I take all this risk and borrow money and do everything I got to do to buy a piece of real estate for the same return, right?
That's right.
So I would expect a premium to do all of that. And what I bet you're about to tell me is that premium is too small, right now, and therefore things aren't selling really well. But go ahead. Yeah.
You kind of already know that because you're on my market letter, so you kind of already have seen that already.
Yeah.
But yeah, the second impact, which is sort of more qualitative in nature, right? The first thing I'm talking about like economics and finance and stuff like that. The second impact that is sort of like an unintended consequence of rate changes, and arguably like maybe even more significant for our industry, like being the real estate industry, is demand destruction in the 1031 market. So 1031 exchanges are way down. I tried to get some data actually for this, and I've been working with one of the big exchange companies to try to start quantifying what's going on with 1031 exchanges. But just take my word for it as a deal maker, 1031 exchanges are way down. There's really not enough 1031 buyers in the market right now to absorb all the deals that were sort of designed for 1031 exchange buyers. And I'm going to get a little financy here, bear with me. That dynamic where we don't have enough 1031 buyers to absorb all the quote unquote 1031 deals, that's sort of pushing this bifurcated market back together. These two different types of buyers that we call sort of the bifurcated nature of the market, that's pushing them towards the convergence. And that is to the benefit of buyers in the sense that it's tending to lower prices, and obviously to the detriment of sellers. So what's the impact of rates? Lower prices relative to rents, And then we've got this demand destruction in the 1031 market, which is like having this compressing effect on the bifurcated market.
Yeah, I'm sure you're going to tell us later when we ask another question, but because there's no 1031 buyers because they can't sell anything that they're trying to sell themselves, right? So in order to be a 1031 buyer, you have to have sold something, and look to place it into a tax deferred vehicle. In your lovely state of California, that there are a lot of the buyers are 1031 buyers. I know historically, just because your tax rates are so high. Let's go to number 3. So question number 3 is: Can you clarify the bifurcated nature of the market and explain why this matters? Good question. What do you think?
Yeah. So at the end of the day, all we're really saying, I hate the word bifurcation, but I wasn't able to find a better one. It's so overused by brokers, but whatever.
Yeah.
The bifurcation sort of cliche, if you want to say that, is kind of referring to, on the one hand, we've got these 1031 exchange buyers, and on the other hand, we have kind of everyone else, and everyone else we can think of as like, it tends to be sophisticated real estate players of various sizes. Everything from like pension funds to REITs to family offices. It's sort of like, it tends to be sophisticated real estate people who are sophisticated on investments and have a decent amount of funds to put into real estate. So those are kind of your two parties, and that we now call like the bifurcated sort of dynamic of the market. So I would say the good news on that is that at the sophisticated end of the market, which REITs and pension funds and people like that end of the market is actually really pretty healthy right now. It's like when you're working in that end of the market doing deals, it's efficient, it's transparent, like it tends to be predictable. The deal makers in that part of the market are hungry. Yes, that part of the market has adjusted pricing because of interest rates. They had to. There was really no way around it. But that end of the market is still healthy. And I'll give you like a quick example, Rick. I brought to a handful of sort of sophisticated buyers a portfolio of 4 QSR deals, like 19 plus years remaining, client that you had recommended to us. And so small package of QSR deals, stabilized stuff, and got immediate response from everyone that I presented the deals to. We had multiple offers within a week of presenting it. The pricing fell right in line with expectation, and it was like, clear proof of concept, if we needed proof, that that end of the market is functioning well. The other side of the bifurcated market is sort of where we have the challenge, and these are the 1031 buyers, and you touched on this a little bit. For background, these are tax motivated people. They're in a lot of cases avoiding really substantial tax liabilities, like it could be $1 million or more of tax liabilities that they're avoiding. And the bottom line with these guys is like, you and I and everyone else on this webinar, we look at a 4.5 cap QSR real estate deal, and when you factor in rent bumps, okay, 4.5 cap deal, like all other things being equal, we're probably talking about 6% returns once we factor in the rent increases. But a 1031 buyer looks at that same 4.5 cap deal, and when they factor in their tax avoidance, that could easily be more like 7 to 8% returns for them. So for them, 4.5 cap deal, because they're getting tax avoidance, is still very attractive, financially speaking. And in addition to like their willingness to pay being a lot higher, they have very limited kind of negotiating leverage, because as you know, they have this 45-day clock, ticking. As soon as they close their deal, they've got 45 days to commit to a short list of 3 properties, and so they end up being highly motivated. And so when the market was really flush with 1031 buyers, you had this like large steady volume of buyers with this like distorted willingness to pay. higher than everybody else. They were extremely competitive because they had a very short clock to work with. There was a lot of them. They had no negotiating leverage. And as a result, these 1031 guys were setting cap rate records like all over the place. So bifurcated market, it's your two buyer types, one being 1031 buyers and the other being everyone else. And now you're starting to see, as you already know, because you're on my market letter, you can see now sort of like what the challenge is. We all sort of became dependent on these 1031 buyers, and they're just not as many as there used to be.
Okay, that's really good. And it's helpful. I think this is going to be one of the key points of this webinar or podcast. Okay, so if you're watching or listening, we have two different markets, tranches of buyers of real estate. If you're a franchisee, one's going to be a 1031 kind of buyer, and the other is going to be an everyone else buyer. The 1031 market's really in rough shape because people who are doing 1031s are tax motivated and they have to have sold something and are looking to exchange quickly. Well, they're not selling much right now because it's hard to sell things, especially
Right.
commercial buildings and things like these that they might use to 1031 into. And it's important to know that those same 1031 buyers are the ones that pay the best prices. Otherwise, you have everybody else, and everybody else is more of a rational buyer who buys based on current economics and current interest rates. And that market's pretty fluid right now, but the prices are different. And I'm guessing different by 10 to 15% in purchase price different. Let's jump into to question number 4. We got a couple of questions stacking up.
That was really well said, by the way.
Oh, hey, there you go. Thank you. I don't know, man. But number 4 is, so you're saying the 1031 market at the moment is kind of sort of crippled, let's just say. Are we left with only one branch then right now? I mean, what's the storyline? And I know we're building up to cap rates, but we're going to be getting to cap rates and all these things that you're going to want to hear about here in about 5 or 10 minutes. Go ahead.
In fact, I've got some charts and stuff like that we can look at current cap rates and trends and all that stuff. That's coming up here in a little bit. So I would say that the 1031 market is not dead. It's really not dead, but it is a much smaller buyer pool than it used to be, and that is part of the challenge. If it were completely shut down, it might actually make things easier because the marketplace would be a lot more predictable, and we could just say there's no 1031 buyers anymore. Yeah. We have to go to the sophisticated players.
Your cap rate is 7 3/4 or 7.5, and that's what you're going to take. Instead, you still see these emails where people are saying 5.75 or 6.25 cap rate, and so people are confused, right? People are
That's exactly right.
What on earth is going on here? I get this all the time when people ask me because
I get it all the time.
Yeah, I'm sure you do.
I've got stuff on the market, and anyway, we're going to get into that later on here. But you said it exactly. That's exactly part of the challenge right now is that there are still 1031 buyers left. Meanwhile, the supply of 1031 deals has been ramping up, and I've got some charts that we're going to look at later that will show that. But so it's like the supply has ramped up of quote unquote 1031 type deals, deals that were kind of built and underwritten and designed with the intention of exiting to the 1031 market. Those types of deals have ramped up in terms of like the amount of inventory, deals that are available that like are ostensibly 1031 type deals. Meanwhile, as we said, like the appetite or the demand for those 1031 deals has fallen. So whereas like the 1031 market for years, we all kind of got used to like this really liquid, efficient, transparent, easy, relatively easy to understand market being all these 1031 buyers. Now it's like idiosyncratic. It's like inefficient. It's very hard to predict what's achievable in terms of price. It's hard to know like which deals will sell and which ones won't. Like looking at deal comps used to be a really reliable predictor of what was achievable. Assuming that you understood your market and you understood, what buyer, like how to push the buyer buttons, the buy buttons and all that stuff. Assuming all that, comps used to be a very, very reliable predictor of what could be achieved, selling a deal in the 1031 market. Now it's like if you put a dozen or 2 dozen very comparable deals on the market, you price them all similarly. Some will sell, others won't. It's going to be very hard to predict in the 1031 market, which ones will and which ones won't. It's very, very idiosyncratic. And it has a lot to do with who's in the 1031 market at like any given point in time, and what pushes their buy button. And a lot of times, like what pushes their buy button is like they have some connection to that real estate of some kind. They went to college in that market. They grew up in that market. They have family in that market, whatever it is, they have some connection. And a lot of times that makes the difference between two deals that ostensibly look exactly the same, but one's one's on this side of Michigan and this one's on the other side of Michigan. This one will sell because somebody resonated, that deal resonated with somebody, whereas this one didn't.
Interesting. Yeah.
So
So it's very, there's not as much demand, and because of that, you're looking for a specific type of buyer, which you can't apply to every piece of real estate that's there. And I'm going to move us forward, if you don't mind, to the next question.
Yeah.
So the fifth question we had is, given the new dynamic in the 1031 market that you're referring to here, what determines who gets a hit and who strikes out? I mean, is it where where I went to college? Is that if there's a property that pops up next to my old drinking hole in college, I'm going to buy it. Otherwise, it ain't going to sell unless the price comes down by 10 or 15%.
So in part of this is, like the real underlying drivers of triple net real estate, that hasn't really changed. And that comes down to like what our former fearless leader of St. Johnson Company, before we were Northmarq, used to call the three legs of the stool, right? And the three legs of the stool were the dirt, the lease, and the tenant. And so like what drives value, what's a large determining factor in whether a deal gets done or not, and at what price. It's sort of the quality of the dirt, and by that I mean, real estate buyers tend to look at the same stuff that the franchisees look at, right? Demographics, what market is in, like how good's the corner, how good's the the population density, traffic, all that stuff. So they're looking at the quality of the dirt, the lease, right? Like how much term is remaining on that lease, the more the better. So triple net buyers and 1031 buyers have always loved 20-year leases. If they can get more than that, they love that too. And also on the lease, they're looking at like expense treatment, ideally, absolute triple net with the tenant, paying everything. And they're looking at how the rents of that lease compare to market. Hopefully you're under market, not over market. And then the last leg of the stool is the tenant, right? So the dirt, the lease, the tenant, and the way that the buyers tend to think about the tenant is in the same way that lenders tend to think about borrowers. They want to understand like that tenant's capacity to meet all their obligations, and not just now, but also long into the future, where we're looking at potentially 20-year lease term and then 20 years of options. So the buyers always want to make sure that tenant like has the capacity to meet all those obligations. And so in addition to like the three legs of the stool, now okay, dirt, lease, tenant, yeah. Now you've also got like luck, right? Is the person that is that 1031 buyer that for whom that your deal resonates because you're on the eastern side of Michigan, not the western side of Michigan. Is that buyer in the market when you are? That's part of it. And then pricing is like more critically important than ever, because there's, as we said, there's more 1031 deals than there are buyers to absorb them all. And so if all else fails, you're looking at, okay, well, your last lever to pull is pricing.
Good. Thank you. Let's jump to question 6 and probably time for some charts. Let's see some charts. But
all right, I've got them teed up.
Yeah, good. So the question specifically is for sellers currently looking to exit via the 1031 market. What does that look like? How does that compare with the sale to REITs? The group of more sophisticated buyers. So Chris, step us through that a little bit. If you call, unbridled capital, we're just going to kind of broadly tell you that the market is about a 7.5 to 7 3/4 cap environment. That's what we're going to tell you. Not knowing anything else about geography, we're just going to kind of give you that perspective, and that is always the perspective of somebody who buys it, if they're a sophisticated REIT, an investor, or a franchisee who would buy the business as well, not the 1031 market. So here you go for it.
All right. So before I start running my yap here, are you like, is it sized right? You can see the chart and everything like that.
I
Yeah,
can.
okay.
I guess. Yeah.
All right.
Yeah.
All right. So what we're looking at here is like listing activity per month across time. So in 2021, on average, you were looking at like 63 QSR listings per month in terms of like deal flow onto the market of stuff on offer. And I limited this to deals with like 15 plus years remaining on the lease. So like new sale lease back and developer product and stuff like that. So big jump here in 2022 in terms of like how much inventory was coming onto the market. I attribute that to like COVID backlog, stuff that got put on hold that came back online and appeared on the market in 2022. And I also attribute this big spike to sellers like rushing their deals to market as we were all starting to become aware that like interest rates are headed up. But still, even looking at 2023 and 2024 year to date compared to 2021, what I'm saying right here is we're like at 137% of what was coming to market in 2021. So suffice to say, a lot of inventory coming to market the last couple of years, and that's continuing, into this year.
Interesting. I wouldn't have thought that. Would have thought inventory was lower, but relatively high. Yeah, keep us going. This is
Relatively high. Yeah.
Yeah.
So the next question, you kind of ask yourself is like, okay, so we know there's a lot of inventory coming onto market, and that's what this blue column is telling you again. It's going year by year, telling you, of QSR deals, 15 plus years remaining on the lease, how many hit the market that year. That's the blue. The green is telling you, I'm going to caveat this here in a second, but the green is telling you how many sold, and then the red is telling you how many didn't sell.
Yeah. So I have not seen. Have not seen these charts from you yet. Yikes! Look at 2024 year to date, guys. 82% ain't selling, 18% are, versus almost the opposite in 2021. Right
now, the thing I was sort of hesitating whether I was going to include 2024 or not. So here's the thing that you need to know about 2024. This is going to look a lot different a year from now, and it's because a lot of the stuff that's come onto the market in 2024, these 737 listings so far, a lot of those just haven't closed yet. So I would say that my expectation is that when we look back at 2024 a year from now, it's probably going to look more like this. I don't know. Can you? I don't know if you can see my cursor, but
yeah, I can. Yeah, you're circling the 50-50. So you're saying half of them sell, half of them don't. Maybe some of these deals in 2024 haven't closed yet, and the numbers will change some. I've got a random question. It's off topic. Is there an element of being damaged goods in the real estate market if you come out to the market with a price that's too aggressive and then you yank it off the market and then you go back onto the market a year later? I mean, if you do that in our industry, we screen very hard on the front end to make sure our clients have reasonable expectations, because if you put your business up for sale and you've priced it too high and it doesn't sell, and then you come back to the market like a year later, or you reduce the price, there's this like declining, this like cascading downward effect of the interest in pricing. What do you say in real estate?
I think that's it can be a factor. I don't think it's as much a factor for what we do, in the sense that the real estate is somewhat commoditized in a sense.
Yeah.
Where I think in your market probably there's more. My guess is that there's more sense of like, oh, you shopped this around and no one wanted it, and now you're back, so I have all the negotiating leverage. That's not so much of an issue on, like in what we do, because the buyers tend to either like the real estate and they like the pricing, or they don't. So whether someone else liked it or not isn't that valuable of information, unless unless the feeling from the buyers is like, oh, there's something wrong with this. So for example, like you shopped a deal, you've had several buyers and none of them worked out. Then your next buyer is like, what's going on with this deal? Is there some skeleton hiding that I'm going to discover later? And if I think that there is, do I want to invest my time, like doing all the diligence only to realize that there's some issue that I wish I had known about on day one that killed it for everyone else. So I would say you don't like actively want to be like putting deals out that are overpriced. It doesn't really help you, but I don't think it's as like urgent of an issue as it might be for what you guys do.
It is in our business. And it's one of the reasons why we accept a far less than half the clients who come to us. It's because if I know that they're wanting more and wanting a price that's too high, it's just not worth it. But yeah, okay, very good. Keep going with your charts. This is great stuff.
I will say I'll make it quick. When the market was this, like brokers and deal makers were, I think, a lot more kind of accommodating in terms of like, okay, seller's a little bit unrealistic on price, but the absorption's so good, like, all right, let's throw it out there, and a couple of years ago, like the market was really working in your favor. Like if the cap rates we're going to look at cap rates here in a second, but if we go back to years past, you see the cap rates were coming down, cap rates down, prices up. So even if you came to market a little bit overpriced, if you waited 6 months, things were getting better. You might not have a buyer in January, but in June, suddenly that 5 cap looks okay. So, but that has changed now, where I think brokers are a lot more reluctant to like make the investment into a deal if they really feel like it's overpriced, because it does start to get expensive after a while. You list stuff and you do make an investment, and if there's no chance it's going to sell because it's just way overpriced, at some point as a deal maker, you kind of just have to say no at some point.
Yeah.
All right, so I guess to tee up the next slide, the pattern here is like, okay, 71% absorption, 55% absorption, 50% absorption. When we get the 24 numbers next year, like when the dust settles on all these, probably we're going to look something like this. Half the deals sold, half the deals didn't. That's my guess. Pure speculation, by the way.
We'll aim for about another 15 minutes, Chris, before we kind of start answering questions and wrap it up.
Okay.
So you just go the way you feel like's the best from here.
All right. So here we're just saying that in 2021, from the day you listed your deal to the day you closed, it was like 100 days. Now it's more like 200 days on average. And that's just QSR stuff. So it takes longer to get these deals. The ones that do sell, it takes longer to get them sold.
So 200 days versus 100 days. Just for those listening who are curious and interested, I would say, if you call us and you want us to sell a company for you, we have a similar kind of trend here, but it's not as extreme. Used to take us 6 months. Now it takes us 8 or 9 months, probably, so we're not double the amount of time. But I think it's indicative of just a harder environment, harder to borrow money, harder to find the right buyer, more contentious negotiations, the whole kit and caboodle. Thank you. Yeah.
And then, so this is my last one. And so this is telling us 3 things. The blue line is telling us on average, what sellers were asking for QSR deals with 15 years of term remaining or more. So the blue line is telling us what they were asking. The red line is telling us where those deals were trading. And then the gap between them is telling us sort of the bid-ask spread and how that's been evolving. And so when you look back in 2021, you can see like buyers and sellers were pretty well aligned in terms of expectations of what things were worth. Then, unsurprisingly, and I love it when the data works out this way, the data tells exactly the story you would think, which is when interest rates started going up in Q2 of 2022, all of a sudden you started seeing sellers telling buyers like, I don't think I agree with you on value here. And it got fairly wide here. It got a little bit kind of narrower over 2023. This, I think, is sort of a quirk of the deals that have closed. I kind of think that this trend, like between these 2 lines, I kind of think that that's going to end up kind of fairly consistent as we go forward in time. But if we look at closing caps, the note I made here is like over the last, whatever it is, 3 years, 2.5 years, on average, you're looking at like 4.5 basis points per month has been sort of the rise in cap rates, or the rate of falling prices, cap rates up, values down. And then the asking prices have been rising at about like 3.5 basis points per month on average.
3.5 basis points. So today, at this very moment, if I was to say, hey, I've got an XYZ tier one franchise in the middle of the country for sale, just a spitballing, what would you tell the client? You'd probably tell them we'd probably get you a 7.5 cap rate from a REIT. What would you say you'd list it at? Kind of roughly, would you say 6.75 to 7 cap, kind of range, and be willing to negotiate downward kind of thing on the 1031 market?
It's going to depend a lot on value drivers. So I'll try to like give you a concise idea of the range. And did we say we're talking about one unit or a portfolio, or did we say?
I mean, I'd love to hear the answer to both, honestly, but I know we don't have all the time, but let's just say one unit. Let's just be simple and say one.
Okay, all right. So a one unit deal, you're probably going to the 1031 market, like, affected as it may be, you're probably still going to the 1031 market for that. And your range on cap rates, assuming that we're talking about like, 15 to 20 year lease, absolute triple net, all that stuff that the buyers like, for like the best of the best, for franchisee credit, you're probably talking about, like if it's Florida, California, one of the preferred markets, again, best of the best franchisee credit, you're probably like shooting for somewhere in the 4 caps. There's still a lot of inventory coming to market in the 4 caps. A lot of it's not moving. But again, like the quirky, unpredictable nature of the 1031 market is, if you've got the time and you've got the ability to like test the market, it's worth testing it, with the expectations that like, okay, we don't know if we're going to have our Goldilocks buyer or not, but we might get lucky. So the best of the best of the best, yeah, you're probably shooting for under 4 cap. You may or may not achieve it.
This isn't most of the people listening. Most of the people listening would be, they own 30 restaurants. They're the tenant. And so Billy Bob LLC is the tenant, who operates the stores and is selling the real estate in Omaha, Nebraska. Okay. Like, just,
Yeah.
you know what I mean? So those,
So that,
yeah.
So like, small size franchisee, personal guarantee.
Yes.
In Omaha, you're probably like 6 cap plus, 6.25, 6.5, something like that. You'll see most of your comparable deals are trying to achieve like 6 cap. Now they're starting to ask like 6.25, but they're probably closing at like 6.5 cap for something like that.
Okay. That's good. See, this is that I think that's probably a good data point, good perspective at least. Well, let's keep going. We've got a few more questions we can ask. I know hope you guys have found this interesting so far. I certainly have. I mean, anything more you want to say with the graphs or anything that we missed?
No. Although if people have questions, I'm happy to tackle them, or we can go back to them.
Let's go now, with 10 more minutes before questions. Let's go to interest rate cuts. Comments on interest rate cuts and maybe also financing. How do you get financing for these deals right now? So what do you think with the interest rate cuts environment? What's that going to do?
So in the grand scheme of things, it's, federal funds rate went up 500 basis points. They just pared it back by 50. So that's a 10% move, to the favorable side, which is, quantitatively speaking, it's not a huge move, but it's definitely good news. It lowered the cost of borrowed funds, which is important in commercial real estate. It lowers benchmark yields, which, like normally means, lower yields, higher prices. So that's good. And then I think, critical to this whole thing is the Fed in the process of lowering in the process of lowering interest rates, the Fed made a real vote of confidence into the market in terms of like the inflation issue, and that we've got that under control. And that is really critical and not talked about enough, in the sense that uncertainty around inflation can be like really troublesome and disruptive to all financial markets, including the real estate market. So like, is it like a light switch that's gonna take us back to 2021? No, it's not. But it's definitely good news, and at least we're moving in the right direction.
Would you anticipate some of these bigger buyers, these REIT buyers, and these private buyers who are really pricing real estate on a day-to-day basis based on what they can borrow money for? That's where you probably would see some more immediate impact, right? On portfolio deals, multi-unit deals. Let's say you've got 10 pieces of real estate you're bringing to the market. Those guys might actually give you a better price today than they did yesterday, than they did last week. True or false?
Yes, that is, I think, both logically true and demonstrably true. You know, like if we go look at what's happening with the offers, and we go talk to some of those folks, some of whom I think are on this webinar, I think it's accurate to say, yeah, they would tell you like their cost of capital is a significant portion of like how they value deals and stuff like that. And so as cost of capital falls, then it positions them to be, you know, more competitive in terms of their offers, and get more aggressive on pricing.
Could you see a 50 basis point interest rate cut eventually to those types of buyers? I mean, could that mean their offer on a portfolio piece of real estate or bunches of real estate could go from like a 7.5 to a 7.25 cap rate based on that 50 basis point move? Could it drop by that much?
I think if we want to just talk about like basic, you know, like just round conceptual level numbers, yeah, is a 50 point, what's that relationship between 50 basis points of Fed change and cap rate change? You know, I don't know, and it's probably different for each buyer, and each buyer type. But so I think where we're probably safe is just saying, like, in general, it's good for it should be like accretive to pricing for sellers, that like interest rates are coming down. It should help the sophisticated buyers and publicly traded buyers and lenders too. It should help them to be like more able to accommodate higher prices than they were before. Exactly how much will depend on who we're talking about and circumstances.
You know, this is a Rick Ormsby comment, but I bet, and you comment on this, that as cap rates start coming down, or pardon me, as interest rates start decreasing or declining, more people will become unreasonable about what they think their real estate is worth.
God, I hope not.
And they'll put their business and they'll put the real estate on the market, and it'll sit at prices that are too high because there aren't enough buyers to take down the real estate. And we actually might be in a position where the interest rate cuts themselves have no impact or a negative impact on the value of real estate for a short amount of time. What do you think?
Yeah, I think that psychology for sure exists in the market, and commercial real estate, you know, tends to have like, you know, it's more than its fair share of sellers who kind of overestimate, you know, the value of what they have. So yeah, I think you're spot on. You know, the thing about commercial real estate and triple net and QSR and all this stuff is that in the long run, and you know this from looking at my market letter every month, in the long run, like all the economic fundamentals and all that textbook stuff, that all proves to be true, but it takes so much longer. So like in the stock market, you know, you look at the stock market, the bond market, those markets incorporate new information like instantaneously. When we were in grad school, one of my professors played a video where they timed how long it took for the market to react to information like on Bloomberg, and it was like 1.5 to 2 seconds. It was like immediate.
In dropping.
Yeah,
it's dropping now. Yeah.
Whereas like in the commercial real estate market, we're like 2 years into higher interest rates, and sellers are still like working their way to like towards accommodating the market and all that stuff. It's just a really totally different animal.
Yeah, it's totally. And that's for another day. I would have liked to have gotten into the investment thesis for real estate, but that's the side of it that I never quite understood with real estate. I mean, as a finance guy by background, I understand that for the liquidity that you get in the stock market, you're supposed to be able to, expect a lower rate of return. But when you have an illiquid asset or one that doesn't reprice or is a little bit, like it's supposed to be a little higher return. And yet in the real estate market, we don't always get that, see that kind of sensible relationship happening the same way you might see as investing in private equity, illiquid but higher returning assets versus like stock market, where that you're not going to beat the market, but you've got liquidity, right? And you've got transparency. But I guess that's what makes deal makers in the middle. Last question then before we go to the questions would be, what about financing? What do you say about financing, Chris? Where are people getting their money these days?
So I'm going to preface this by saying I'm not the expert on, I'm not super close to the debt markets. I mostly look to our debt market folks, like for that area of expertise. But I will say that, I'm happy to tell you what they're telling me right now. And what they're telling me is like, up until this point, a certain amount of the lender pool had sort of lost appetite for triple net real estate in general. They were somewhat overexposed to the sector. The lending rates were up. The sellers over the last couple of years were still trying to achieve really low cap rates. And that's kind of a tough environment to get deals done. We talk about negative leverage where it's like, okay, every dollar you borrow kind of reduces your return because it costs you more to borrow it than you're getting out of the thing you're buying. So you were looking at like negative leverage. The lenders were getting more conservative on loan to value because of what was happening to the values of the properties. There was more scrutiny on the credit from the lenders, and that just made deals hard. So a lot of lenders had kind of put triple net in general on the back burner a bit. Financing was available, but smaller pool, harder to get deals done. Now, as of a conversation I had Monday with a loan broker that I really like working with, the feedback is that things are definitely getting better. That there's like the appetite is coming back in as like that spread between cap rates and lending rates starts to improve. The appetite from the lenders is coming back. And so it's not so much that the lenders didn't want the exposure to triple net. It was more just an issue of like the numbers just weren't working. And I think a lot of the lenders just said like, for them, it wasn't like a good use of time. It wasn't a fruitful place to be lending, was a triple net market because the numbers weren't working. And so meanwhile, just to kind of wrap up, like the lending aspect of it, what is still true now is that when you look at spreads, and again, I'm just kind of reiterating what my guys are telling me. For in recent memory, like 200 to 250 basis points over the treasury rate, that was kind of what you expected from like your bank lenders and credit unions and stuff like that. And my guys tell me that's still true. 200 to 250 basis points is like a good way to kind of guesstimate, like where the financing rates are from banks and credit unions. And so that would put you right now at like high fives, low sixes, maybe into the mid sixes on the interest rate. And then, there's some range around that too, where for certain deals, certain circumstances, certain types of lenders, you may be able to dip into the low fives or mid fives right now. Or if you have a deal that needs to get creative, or really you need like CMBS is your best lender, then you may be looking at much higher rates than actually, I probably shouldn't say much higher rates, but you may be looking at sort of higher rates than low to mid sixes.
Couple of questions. Thank you. I think as I look at the 5 or 6 questions we have here, most of them have been answered. But there's one that I like here, which is what makes a difference, state, brand, any comments you could make specifically within QSR or outside, territories, areas of the country where things sell better than other places, brands that are more, exciting, just real quickly in a couple minutes.
Yeah, this is a great question. I did some data on this month. Hold on, I'm just pulling it up on my screen here.
And if, by the way, while he's doing this, if you're watching or listening and you have any questions, that weren't answered and you want further information, just email me. You know how to get me, and we'll try to plug you into Chris and get questions answered for you along the way. and only so much you can do in 1 hour.
All right,
We
so
just got a couple of minutes here. Yeah.
yeah, I'm going to minimize my screen and then share this.
Started screen sharing.
All right, so are you seeing my banded Excel table here, value driver and all that? Yeah, okay.
Yes.
So I looked at 3 value drivers to look at how significant they are now versus before. So like in 2021, if you compared deals over $3 million to deals under $3 million, this isn't so much cap rate as much as it is sell through or absorption. But in 2021, stay with me here, you being under $3 million was a 12% advantage in terms of your odds of getting a deal done. In 2023, it was a 30% advantage. Being a small deal, you had like a 30% advantage in terms of getting your deal done. In 2024 so far, being under $3 million versus over is a 76% advantage,
Wow.
right? If you were, I looked at whether you're in a preferred market. So this goes to kind of the geography, whether you're in California or Florida versus, Dubuque, Iowa or something like that. Nothing against Dubuque, Iowa, but in terms of desirability of the market, same kind of result. In years past, yeah, you got a premium for, or you were better odds of getting absorbed, your deal getting absorbed if you were in a preferred market. But as time has gone by, that's gotten more and more important. There's something weird going on here where in terms of how much lease term remaining, yeah, you can see the same as the others. As time has gone by and we've gotten further into this stuff the last few years, having more lease term has gotten more and more important in terms of whether you were able to sell your deal or not. There's something weird going on this year, TBD what that is. But getting back to your question, yeah, we can quantify looking at comps, like how significant is it to be in a preferred real estate market or like the brand or the credit. Some are easier to quantify than others, but they definitely do make an impact for sure.
It's great. Thank you for answering that, and I think that's a wrap for us. I hope you all found this Chris's discussion here knowledgeable and informational. I have, and so thank you for putting it together and being available. Thank you for everyone who's watching and who will watch, and thank you for listening as well in the restaurant boiler room. We'll get this information out to you and on the website. We'll hope to see you at RFDC in about a month and a half. And thanks again, Chris. You did a great job, and we really appreciate your time.
Yeah, anytime. Happy to do it.
Awesome. Thank you, guys. Appreciate everything. Take care.